Hi, I'm Stephen Glass and I'm a co-manager of the Pengana International Equities Limited fund, which is traded on the ASX under the ticker PIA. This slide shows the main features of the fund. Now, there's a lot there, so I'm not going to go through everything. I'll just highlight the three key aspects in this slide. I'll start off with it is truly a global fund. So this fund invests in companies across the world in both developed and emerging markets. We're not going to bucket ourselves into one region. We think there are opportunities everywhere and we broadly look in these different regions and we've demonstrated that we can do it. The second point I'd like to emphasise is that it's truly an ethical fund. We believe that if you're a shareholder, you're an owner, and I don't want to be a shareholder of a company that damages the world. And putting this even a bit further, if you're a unit holder in our fund, you're effectively a shareholder in these companies. And if you don't want to be a shareholder in companies that really do bad to the world, then I think an ethical fund would be right for you. The final point that I think is really important to emphasise is that we consider this fund an evergreen fund, which means it's the type of fund that we would like people to invest in and can just hold through all different market environments, through ups and downs, and it's just going to be steady and deliver a good return without taking too much risk. So what exactly is an evergreen fund? We think an evergreen fund has to have three aims. It has to make money. Of course, that's why people invest. But it also needs to avoid those large drawdowns because they hurt. If a stock drops 30%, it has to increase almost 50% to make up for it. So avoiding large drawdowns help generate good returns. And thirdly, and critically, we want to minimize volatility. Volatility hurts people. People are emotional and they can take up money at the wrong time and put it in at the wrong time. So providing a nice steady return, they're less likely to do that. They will put it in and get a nice steady through the cycle return. So three aims are very important to us and we don't think you should ever look at one without the other two. And the way we go about delivering on these aims is we've got an ethical framework. So before we invest in anything, we ensure that it complies with the ethical framework, which can be thought as a quality screen. We've got a unique portfolio construction process, which I'm going to speak to. And finally, we are active managers. You can count on us to take action if the data tells us that we should. We will sell if valuations become extreme, we will buy if they become cheap, and we will make sure that we get out of regions that are starting to look politically risky. So starting with the portfolio construction methodology and how we pick stocks. It all begins with our ethical framework. So before we invest in any company, we run it through various ethical screens to ensure that it complies with the ethical requirements that we communicate to you. We then only see companies that are highly cash flow generative. Cash flow generative companies are generally the best types of businesses, and they're ones that you're less likely to be tricked by accounting from. So you can't spend accounting earnings, you can spend cash, and we think cash is king and that's where we focus our attention. Valuation is always very important and cheap is always better. However, we don't mind paying a reasonable valuation for a very good company. What we won't ever do is pay more than what we think a business is worth. Growth is important. We want companies with sustainable competitive advantages, structural tailwinds and good management teams. Time is a friend of the growing company. Growing companies also can hide mistakes. So if you get something wrong, a little bit wrong with valuation, if the company grows enough, it will fix that problem. And finally, growing companies have good corporate cultures. It's the kind of place people want to be. So good corporate culture is often an ingredient to success. And finally, and I think potentially most importantly, is we avoid companies that are likely to blow up. So we avoid highly geared businesses. We don't invest in companies with debt. We don't invest in companies that have poor corporate governance. We don't invest in companies that are binary bets that are either worth a lot or a little based on one event. And we don't invest in companies with structural headwinds because they become like ducks. They're paddling in water, but they can never really move forward. And when you bring those all together, even if we get everything wrong, and everyone gets things wrong once in a while, either through making a mistake in their analysis or just because of bad luck, we still won't lose a lot of money on a particular stock. We think this is logical and common sense. It's an easy thing to say, to go through this process, but it's not always an easy thing to do. But we've been doing it for a long time and we think we do it well. This slide shows our ethical framework, and it's something that we've put a lot of time and effort into since we started managing this fund about 2 years ago. Ethics have always been important to us, but we understand that we are not the grand judges of all things ethical. We need to do work on it. So what we did, we employed an external consulting firm to do an in-depth study into what exactly is ethical investing. We spent a lot of money, of our own money, doing this, and they spent over 6 months doing this review. And we're now absolutely confident that what we have is the premium ethical product in the market. We then employed another firm called Sustainalytics. They're a pure play ethical research firm, and we use them as a tool to actually ensure that we're complying with all our ethical guidelines. And then we have an ethical analyst who just looks at the ethics of our companies. And finally, we have independent auditors to ensure that we comply. So when you bring it all together, I feel very confident that our fund is one of the premium ethical funds out there. I consider this slide one of the most important because it talks to our portfolio construction process, which is something that makes us truly unique. And what it involves is we divide all companies and our portfolio into 3 buckets: core, cyclical, and opportunistic. Core are those really high quality, stable businesses trading on good valuations that take you through all different market environments. The vast majority of the portfolio is in core. 60 to 80% of the fund is invested in core stocks at all times. Now, whilst it's great to be in these stocks and they do let you sleep well at night, the fact of the matter is there are other ways to make money in the market, and in fact, investing in these other areas also help reduce risk through diversification. This brings us to cyclical. Cyclical are perfectly good companies that happen to operate in cyclical industries: banks, industrials, agriculture. 0 to 30% of the fund is invested in cyclical. So you can make a lot of money from these companies, but you can also lose a lot, which is why it's important to have special risk controls around them, which begin with identifying these companies as cyclical. So we have smaller position sizes in cyclical, and we have stop losses. Opportunistic are unique company-specific opportunities. So it could be fast growth companies that are too expensive to be considered core, or it could be turnaround situations that aren't yet at sufficient quality to be considered core. Just like cyclical, you can make a lot of money from these companies, but you can also lose a lot, which is why we've got special risk controls around opportunistic. These stocks account for 0 to 20% of the fund. We have smaller position weight to them, and again, we employ stop losses. And when you bring it all together, I think the key benefit of this approach is it creates a nicely diversified and balanced portfolio, which means it's a star portfolio rather than just a portfolio of stars. One of the comments I get when I show people this slide is they look at it and they say, wow, we haven't seen many of these companies before. It's very different to the other global managers. Perhaps we are, I don't know. I don't spend a lot of time looking at other people's holdings. What I can say is we're not different for the sake of being different. To the extent we are different, I think it's because we're not defining ourselves as either value or growth. We bring them together. We are value and growth. And also, we have a very broad mandate by structure. We look across the world and we look across market cap ranges. So we are very comfortable in investing across different regions, industries, and market caps. And I think that results in often a unique portfolio. So the key message from this slide is we've got a unique portfolio construction methodology that creates a star portfolio rather than just a portfolio of stars. So how's the portfolio actually doing since we started managing it? And we're very proud to say it's delivered on all 3 of its goals. It's delivered a compounded annual return of 10%, our beta is 0.8, and it's actually saved money when it counts. This slide provides an attribution since we started managing it. And what it shows is that we have invested across different regions and we have invested across different industries and market cap ranges. And in general, we've outperformed the index on each of those sectors. So for example, we've delivered 12% from North America compared to the index's 11%. We've delivered 10% from Asia ex-Japan compared to the index's 9%. And we've generated 8.7% from Europe, whereas the index is 4.3%. So we've demonstrated an ability to invest across different regions. The same story could be said when we look down sectors and if we look at market cap ranges. So we've demonstrated an ability to invest across different regions, industries and market cap ranges. And I think that's really important going forward because to date, returns have been very concentrated in large cap US growth. And if you think that won't last forever and in the future you're going to have to be able to invest in Europe, you're going to have to be able to invest in financials, and you're going to have to be able to invest in small caps, and then perhaps the story will change to some other theme. You want to be in a fund manager who's demonstrated an ability to invest in all those different areas, and I'm very proud that we have. I think this is a critical slide because it shows how we've done when the market's dropped a lot. So we've chosen every single day that the market's dropped more than 1.5% since we started managing the fund. The market is that greyish bar chart and we are the red. And what it shows is that every single time the market's dropped a lot, we've dropped a lot less. We would expect this because it's the type of companies we invest in and how we put our portfolio together. I can't promise it, but I can say this is our expectation, and we're very, very proud that we have actually saved money when it matters most. So thank you very much for your attention, and if this does seem of interest to you, please just fill out the form below. Thank you very much.